We don't expect a recession. We've long thought that we'd see a soft landing, particularly in the US, and our economists think the probability of recession over the next year is only 15%, which is pretty much the same as the probability in any given year. So we're pretty confident in that view, and that is not a bad environment for equities, particularly when you consider also that inflation has peaked. And although rates we think will not come down as quickly as the market is pricing, and that's a risk, it's not a very bad environment. That being said, alternative investments are looking attractive, cash, bonds, and that reduces the relative attraction of equities. And also, I think we have to acknowledge we're not seeing much in the way of profit growth, so selectivity, I think, is still going to be crucial in a relatively moderate index environment.
The higher for longer story is one narrative that also changes the view on bonds, right, in terms of real yields. We've been talking a lot about the nominal neutral rate, whether that's higher for longer from here because of those short-term yields going up, the market concerned about how the US pays back its debts and that inflation is lingering for much longer than anticipated. In that type of narrative is not one that we've been used to for many years. The past decade has not looked like that. What does it do in terms of changing portfolio construction?
Well, I think you raise a crucial point, Karen, because one of the fundamental shifts that we're seeing is a rise in the cost of capital. As you say, this is something we have not been used to in the last 10 or 15 years. Real interest rates, particularly in the US, have risen quite sharply. And this has had an impact already on differential business models, and it's started to create more value attributed to strong companies with strong balance sheets that are cash generative and that can compound returns over time. So, for example, technology has been a crucial driver again in the equity markets this year, but there's a huge difference now between speculative, unprofitable tech, which had very high valuations but has seen that erode as interest rates have gone up, and then very profitable, strong balance sheet tech, which is seen as more defensive. And I think this differentiation around the use of cash and the availability of cash is going to be pretty crucial.
Someone I loved speaking to, and I saw him a lot in Davos as well, was Scott Minard, and unfortunately Scott was taken from us way too young at the tail end of last year. But I was just looking back at some of Scott's comments, and I always loved listening to him as well. And he wrote a piece just a couple of months before his passing, it was October last year, said, "The sound you hear is the Fed breaking something. October will test the Fed's resolve." Now, a lot of people were in Scott's camp. They thought that if the Fed carries on with this aggressive tightening cycle, they will break something. Can you just give me some analysis of why? And again, you point out that Goldman actually sees a widening chance of a soft landing, less chance of a recession as well. Why were so many people convinced that the Fed would break something, and now they seem equally convinced the Fed won't break something?
Well, I think the reason people thought that the Fed would raise something, cause problems, is because interest rates have risen very rapidly from an extraordinarily low level. And typically when you see that speed of appreciation of interest rates, and when you get negative yield curves, collapsing money supply growth, you would typically see a big downturn. But I think there are some important caveats, one being a very strong...
So those caveats were there when they were making these calls,
yes,
by the way.
Absolutely.